90% of traders blow up their accounts within the first year, not because they can't read charts or lack intelligence. They fail because they commit financial suicide through constant motion. Here's the brutal truth most trading educators won't tell you. The amateur thinks trading means action, while the professional knows that waiting is often the most profitable position you'll never take. Walk into any trading room and witness the same tragic scene. Screens flickering with red and green candles, fingers dancing across keyboards, orders flying like bullets from a machine gun. The amateur trader sits hunched over their desk, eyes bloodshot from 1-minute charts, convinced every tick demands immediate attention. They measure worth by trade, frequency, speed of reflexes, market participation rate. Buy, sell, scalp, flip. They confuse motion with progress, activity with achievement. This motion addiction rewires their brains to fail. Every unnecessary trade reinforces neural pathways screaming, "Do something." When markets present uncertainty, the amateur becomes enslaved to action, unable to distinguish productive trading from compulsive gambling. They check positions obsessively, adjust stops emotionally, enter trades from boredom rather than opportunity. The market becomes their drug. Every tick feeds their addiction to constant stimulation. The professional measures success differently, not by trades taken, but by trades avoided. They understand the market pays patience, not activity. Where amateurs see opportunity in every fluctuation, professionals see mostly noise. Where amateurs feel compelled to act, professionals feel comfortable waiting. This isn't laziness. This is understanding a profound truth. Markets reward those who sit still during chaos and act decisively when clarity emerges. Jesse Livermore discovered this through decades of painful experience. He made $3 million shorting the 1907 panic, lost it through overconfidence, rebuilt by 1929, then lost everything again through impatience and overtrading. But through each boom-bust cycle, he developed understanding, separating him from failed speculators. His biggest profits came not from analysis or timing, but from sitting tight once he was right. Livermore's greatest insight wasn't about when to buy or sell. It was about when to do absolutely nothing. He made and lost millions multiple times, but his ultimate wisdom transcended individual trades. "It was never my thinking that made the big money for me," he said. "It was my sitting." This wasn't trading folklore. This was systematic methodology based on 3 hidden rules most traders never discover. Here's the counterintuitive promise transforming your results. Your next 50% improvement won't come from better entries or faster execution. It will come from longer, calmer holds and strategic inaction. The mathematics prove this. Avoid just 3 mediocre trades weekly at 1% loss each, and you preserve 12% quarterly through subtraction alone. Market veterans win by not bleeding. They understand that waiting is a position. Confirmation precedes conviction, and size funds patience. Your brain is wired to fail at this game. The same neurological systems helping ancestors survive dangerous environments now sabotage trading accounts. Dopamine hits from frequent trading. Adrenaline rushes from rapid decisions. Social validation from appearing active. These psychological rewards create feedback loops, destroying long-term profitability while feeling productive momentarily. The constant stream of price data triggers fight or flight responses, making every moment of inaction feel like missed opportunity. But evolution's programming becomes liability in trading environments. The human brain craves immediate gratification, seeks quick resolution to uncertainty, and interprets stillness as weakness. Professional traders overcome these biological handicaps through systematic protocols, removing emotion from critical decisions. They replace instinct with rules, impulse with process, hope with mathematics. The amateur today faces identical psychological traps that destroyed countless speculators in Livermore's era. Technology accelerated the pace, but fundamental challenges remain unchanged. They mistake random noise for meaningful signals, entering during market indecision and exiting during moments when persistence pays off. They trade fears and hopes instead of reading the tape's clear messages. Most traders think they need stronger hands to hold through volatility. They believe willpower and emotional control are missing ingredients in their trading recipe. They focus on the wrong solution. They don't need stronger hands. They need stronger rules. They need systematic protocols making patience profitable, mathematical frameworks removing emotion, and clear criteria distinguishing productive waiting from destructive hesitation. By the end of this breakdown, you'll understand 3 specific situations where Livermore would sit on his hands while amateurs frantically trade themselves into poverty. The first situation involves recognizing what he called pivotal points, moments where probability of significant movement shifts dramatically in your favor. Most traders completely misread them, confusing market noise with genuine opportunity signals. But first, you must understand why your brain sabotages success. The path forward begins with distinguishing when markets actually speak versus just making noise. This distinction forms the foundation of everything following, the bedrock upon which profitable patience builds. Strong hands without rules become stubborn. Rules without discipline become worthless. You need both: frameworks telling you when to act, and discipline to do nothing until that moment arrives. The next step is learning to hear market language. When does price action translate to clear, actionable sentences? When does the tape whisper? When does it shout? Answer those questions, and sitting becomes your most powerful weapon. Amateurs sit at the wrong times. They hold through noise and panic sell through structure. This backwards behavior destroys more accounts than any technical analysis mistake. They cling to losing positions during random fluctuations, then abandon winning positions precisely when meaningful moves begin. Professionals reverse this entirely. They ignore noise and only sit when structure changes. Jesse Livermore called these moments pivotal points, where the line of least resistance definitively shifts from one direction to another. Understanding pivotal points separates systematic traders from gambling addicts. These aren't mystical concepts requiring supernatural intuition. They're mathematical events with clear signatures visible to anyone willing to study price and volume relationships. The amateur sees every price movement as potentially significant. The professional waits for the market to prove significance through unmistakable evidence. Picture this scenario playing out thousands of times daily. You're watching a stock basing at 5-0 for several weeks. The pattern looks clean. Volume has contracted, and this stuff appears promising. Suddenly, price pops to 5-0 for several weeks. The pattern looks clean. Volume has contracted, and this too appears promising. Suddenly, price pops to 5-0, 80, on what seems like buying interest. Your pulse quickens. This could be the breakout you've been waiting for. You buy immediately, risking 2% of your account on the move. But something feels wrong. The volume accompanying this move registers only slightly above average, maybe 1.2 times normal flow. The tape shows sporadic buying with no sustained aggression. Spreads widen during the advance, suggesting thin participation. By afternoon, price fades back under 50. You defend the position emotionally, telling yourself the breakout just needs to develop. The next day brings more weakness. Price closes at 50. You defend the position emotionally, telling yourself the breakout just needs time to develop. The next day brings more weakness. Price closes at 49. 75, then 49.4. Yours to pot 49.4. Yours to pot 49. 20 triggers, locking in the loss you should have avoided entirely. 1 week later, the same stock breaks 5-1 on volume measuring 2. 5 times the 20-day average. The tape shows aggressive buying into the close with tight spreads and sustained momentum. Multiple prints lift offers systematically. Price closes at. Price closes at 5-1 on volume measuring 2. 5 times the 20-day average. Tape shows aggressive buying into the close with tight spreads and sustained momentum. Multiple prints lift offers systematically. Price closes at 5-1. 15, just below the high of day, demonstrating institutional sponsorship through the session. This second break was the pivot. The first was noise masquerading as opportunity. The first whispered uncertainty. The second shouted conviction. Here's Livermore's pivotal point protocol refined through decades of market observation. First, demand a decisive break of a key level prior swing high, swing low, or base edge, accompanied by clear expansion. Look for volume measuring at least 2 times the recent average or obvious surge in tape speed. This isn't arbitrary. Genuine moves require fuel. Half-hearted advances on light volume deserve half-hearted attention, meaning none at all. The key levels matter because they represent trapped traders. When $50 resistance finally breaks on heavy volume, every seller who got short above that level becomes potential buying fuel. Their pain becomes your gain as stops trigger and short covering accelerates the move. Base edges work similarly. They represent equilibrium zones where supply and demand balanced until one side capitulated. Second, require confirmation through a strong close beyond that level, not just an intraday spike and fade. Markets reveal intentions through closing action. A stock breaking 5-0 intraday but closing at 501 intraday but closing at 50 sends mixed messages. A stock breaking 5-1 and closing at 5-1 and closing at 5-1. 10 speaks clearly. The close represents the day's final consensus of value after all participants voted with their money. Closing strength signals institutional sponsorship. Professional money managers don't chase spikes, they accumulate methodically throughout sessions, supporting price into the close. When you see persistent bid support, narrowing spreads, and little slippage on market orders, institutions are building positions. This creates the foundation for sustained moves. Third, watch for the retest that holds. Most genuine breakouts experience quick pullbacks, testing the breakout level within days. Old resistance should become new support. If the stock breaks 5-1 convincingly, then pulls back to 5-1 convincingly, then pulls back to 5-1, 20, and bounces aggressively, that retest validates the pivot. The shallow nature of the pullback, only 20 cents versus the dollar move, demonstrates underlying strength. Mark that retest low. It becomes your structural line in the sand. Above it, you sit tight. Below it, you accept the signal was premature and step aside. Successful retests typically show 3 characteristics. They're quick, shallow, and rejected with energy. Buyers show up on the bid immediately, and the tape reveals urgency without desperation. The amateur buys every pop, hoping it continues into something meaningful. They mistake every uptick for the beginning of a major move. They enter positions based on wishful thinking rather than market evidence. When these hope trades fail, they blame bad luck or manipulation rather than poor process. The professional waits for the market to prove its intent through volume, follow-through, and successful retests. They understand that real moves announce themselves through unmistakable price and volume signatures. They don't guess at pivotal points. They wait for confirmation, then act decisively when evidence accumulates. Here's the pattern interrupt, transforming your approach. You don't need to predict pivotal points. You need to recognize them after they develop. This removes the impossible burden of forecasting and replaces it with achievable pattern recognition skills. The market tells you when character changes through observable evidence if you know how to listen to the tape. Markets communicate through a language of price and volume. When volume expands dramatically on decisive breaks, the market speaks loudly. When volume remains subdued during price movements, the market barely whispers. Trade the shouts, ignore the whispers. This distinction alone eliminates 90% of mediocre opportunities. Anchor this maxim. If it's not at a pivotal point, it's not your trade. This single rule forces you to wait for high-probability setups rather than settling for marginal ones. It transforms you from reactive to selective, from hopeful to systematic. But recognizing the setup is only half the battle. The other half is funding your patience with proper position sizing so you can actually sit through the normal reactions that shake out weak hands. Without mathematical discipline backing your pattern recognition, even perfect timing becomes worthless when fear forces premature exits. Oversize the first position, and you'll micromanage every tick. Fear and greed hijack decisions you should never touch. This is the mathematical trap destroying more traders than any technical analysis mistake. When your position size exceeds your emotional capacity, every price movement becomes personal. Every pullback triggers panic, selling at exactly the wrong moment. Professionals buy patience with mathematics, not willpower. They risk small, place stops where structure lives, and add only when the tape pays them. Here's the mathematical foundation of patience that separated Livermore from failed speculators. Risk 0.5 to 1% of account equity per initial trade. On a 100,000 account, that translates to maximum 100,000 account. That translates to maximum $5,002, $1,000 loss if your stop triggers. This isn't conservative trading, this is intelligent trading. This sizing allows you to be wrong 10 consecutive times and still retain 90% of your capital for the next opportunity. Calculate your position size using this precise formula. Divide your maximum dollar risk by the distance between your entry and stop loss. If you're willing to risk 500 and your stop sits 500 and your stop sits 150 below your entry, you can buy 333 shares maximum. If the structural stop implies risking more than 1% of your account, reduce shares or pass entirely. No forced trades, no exceptions. This mathematical constraint buys you calm attention and real patience. The structural stop determines everything. Place stops beyond noisy wicks, at meaningful swing points or pivot retest levels where your setup definitively fails. If your pivot breakout occurs at 51, retest low prints at 51, retest low prints at 50, 40, your stop belongs at 50.19, not 50.19, not 50, 90. Stops positioned at 50.90 guaranteed ETH by random market noise. Stops at 50.90 guaranteed ETH by random market noise. Stops at 50. 19. Respect market structure and give your trade room to breathe through. Normal volatility. Stops make you brave because they cap the unknown. They transform unlimited risk into defined risk. When you know your maximum loss before entering, you can focus on reading the tape rather than monitoring your pulse. This psychological shift changes everything about how you respond to normal market fluctuations. Livermore's real genius emerged in his pyramiding protocol, adding only with the market's money using systematic position scaling. Follow his 1-1-2 ladder approach. Initial unit on the pivot breakout. Second unit after achieving +1 R profit and breaking from tight consolidation. Third unit after the next higher pivot level holds support. This mathematical progression ensures worst-case drawdown risks only open profits, never core capital. Your initial 500 risk remains constant regardless of positions increases. When you add your second unit at 500 risk remains constant regardless of positions increases. When you add your second unit at 52.50, after the stock consolidated, above 51.5, trail your stop to 51.5. Trail your stop to 5-1-30, protecting both units while giving the position breathing room. The market funds increased exposure through demonstrated strength. After each addition, trail your stop under the most recent unit's protective structure. If your third unit enters at 54.20 after another pivot holds, move your stop to 54.20 after another pivot holds, move your stop to 5.3.10. This ensures you're never risking more than your original $500 on the entire position, regardless of final size. The mathematics remove emotion from scaling decisions. Write down your plan before clicking buy. Entry price, structural stop level, unit size tied to 1%, maximum risk, +1 R target in dollars, predetermined add levels, and trailing stop locations. Written plans survive volatility better than verbal promises. When stress rises, review the math and let the math review you. The amateur averages down into weakness, throwing good money after bad. They buy more shares as price moves against them, hoping to reduce average cost basis. This mathematical fallacy compounds losses exponentially. Instead of capping risk, they increase exposure to failing ideas. The professional pyramids into strength, letting the market fund increased exposure. They add shares only when price moves favorably, when volume confirms the move, when the tape shows institutional sponsorship. This approach aligns position size with probability. When you're right, you get bigger. When you're wrong, you stay small. Integrate time stops into your sizing protocol. If your trade hasn't reached +1 R profit within 5 to 10 sessions in a trending market, Reassess the idea's validity. Slow tape equals stale idea. Markets that move decisively show intentions quickly. Cut stagnant positions and preserve capital for clearer opportunities, showing immediate confirmation. The mathematics reveal a profound truth. Your patience budget directly correlates with your risk per trade. Risk 0.5%, and normal pullbacks feel manageable. Risk 5%, and every tick becomes emotional torture. Size determines whether you can execute your trading plan or abandon it under pressure. Professional traders understand that position size is their primary tool for managing emotions. They don't rely on mental toughness, they rely on mathematics that make patience profitable and fear irrelevant. When your risk is properly sized, you can focus on reading market structure rather than watching profit and loss fluctuations. Anchor these maxims. Add to strength, not to hope. Size reveals your patience budget. These principles transform position sizing from guesswork into systematic methodology. They ensure your mathematical foundation supports rather than undermines your technical analysis skills. But even with perfect sizing and stops, you need to know when sitting becomes stubbornness. The tape whispers before it shouts, and those whispers tell you when to stand up and leave. Recognizing when patience transforms from asset to liability requires understanding the subtle signals preceding major character changes in market behavior. Here's the ultimate paradox that destroys 90% of traders. Sometimes the most profitable action is doing absolutely nothing. The amateur sees waiting as lost opportunity cost. Every moment not actively trading feels like money left on the table. They calculate phantom profits from moves they didn't take, torturing themselves with imaginary gains. The professional sees waiting as compound interest on future trades. They understand that every bad trade avoided is a good trade preserved. Every marginal setup skipped is capital preserved for genuine opportunities. This reframe transforms your entire relationship with inaction. Waiting becomes an active position generating real returns through capital preservation and mental clarity. When you're not risking money on mediocre setups, you're compounding your account through subtraction. When you're not emotionally drained from constant trading, you're building psychological reserves for decisive moments, requiring maximum focus and aggression. Jesse Livermore demonstrated this principle through one of his most powerful yet overlooked strategies. After a damaging streak in 1917, he sat out the market for 6 months, not 6 days or 6 weeks, 6 full months of complete inaction. He didn't sulk in his apartment or force trades to get even with the market. He studied tape patterns without placing orders, refined his protocols through observation, analyzed his mistakes without the pressure of active positions, and waited for setups matching his strict criteria. When Livermore returned to active trading, he recovered his losses in 3 weeks. Not 3 months or 3 years. 3 weeks of focused, high-conviction trading. This happened because he traded only his highest probability opportunities with maximum position size and complete emotional clarity. The forced waiting period eliminated his urgency, refined his judgment, and concentrated his capital on perfect setups rather than scattered across marginal ones. His patience bought him precision. Here's the compound effect of strategic waiting that most traders never calculate. Avoid just 3 losing trades per month at 2% loss each, and you preserve 6% of capital monthly through pure discipline. Over a year, this compounds to massive outperformance compared to traders who can't resist marginal setups. The mathematics are undeniable. 100,000 preserved through discipline significantly outperforms 100,000 preserved through discipline significantly outperforms side 8,000 generated through constant activity and slow bleeding. But the real power emerges when you consider psychological compounding. Each avoided loss preserves not just capital but confidence. Each resisted temptation strengthens your discipline muscle. Each period of strategic inaction builds patience reserves for moments when aggressive action becomes appropriate. The mental capital preserved through waiting often exceeds the financial capital preserved. Livermore identified 3 specific danger zones requiring complete inaction. First, choppy, range-bound markets with no clear trend direction. He called this dead money capital tied up in directionless movements that grind accounts through death by 1,000 cuts. Picture a stock oscillating between 49 and 4, 9 and 5, 1 for 15 sessions. You see a 1-minute surge to 51, 20, and feel the itch. Instead, you mark the range, right, no trade inside, and wait. Days later, a decisive move with 2x volume Carriesto, 51, 20, and feel the itch. Instead, you mark the range, right, no trade inside, and wait. Days later, a decisive move with 2x volume Carriesto, 5, 2, 30, and holds into the close. Second danger zone. News-heavy periods where emotional reactions override technical analysis. Earnings seasons. Federal Reserve announcements. Geopolitical crises. These events trigger volatility that looks like opportunity, but actually represents chaos. CPI data shocks hit the tape. Futures rip and reverse twice in 10 minutes. You want to fade the second spike. You don't. You wait for the daily bar to close, then judge the damage with clear perspective. Third danger zone. Personal hot streaks, where recent success breeds dangerous overconfidence. 5 winners in a row make you want to double size on the 6th trade. You don't. You cap risk at 0.5% and demand A-plus setups only. Professional traders understand that feeling invincible precedes major losses. They fight euphoria with structure, not more trades. The amateur forces trades in these conditions because they fear missing out. They can't distinguish between being out of the market and being out of opportunities. They mistake activity for progress, confusing motion with advancement. They trade their fears rather than following their systems, creating the very losses they're trying to avoid. The professional recognizes that preserving capital during unclear periods is more valuable than chasing marginal opportunities. They understand the best trades come when conditions align perfectly, not when they need them to align. They wait for the market to present clear, high-probability setups, rather than forcing mediocre ones into profitability through hope and oversized positions. During waiting periods, maintain active preparation rather than passive boredom. Keep a trading journal focused specifically on missed opportunities that turned out poorly. Record the setups you almost took, the reasons you avoided them, and their subsequent outcomes. This reinforces the value of discipline by showing concrete evidence that your patience saved money. Nothing strengthens resolve like reading your own avoided carnage. Set specific, measurable criteria for re-entering active trading. Clear trend resumption with volume confirmation. Decisive technical breakouts from consolidation patterns, or volatility expansion after contraction periods. Don't trade your way back in gradually through small positions and tentative entries. Wait for unmistakable signals, then act decisively with full position sizes and complete conviction. Create structured routines during waiting periods. Study successful trades from your journal. Analyze market leaders for future opportunities. Refine your screening criteria, or educate yourself on new technical concepts. Transform downtime into skill-building time rather than lost time. Use this period to sharpen your tools for the next campaign. Anchor this principle. Patience is not about doing nothing. It's about doing nothing until you can do everything right. This reframe eliminates guilt associated with inaction and replaces it with purposeful preparation for decisive action. Flat is a position. Waiting is work. Cash earns clarity. But there's one final piece completing the puzzle. Recognizing when your waiting period should end and when sitting becomes stubbornness. Even strategic patience requires knowing when to act. When market conditions shift from unclear to obvious, the tape whispers before it shouts, and those whispers tell you when to stand up and leave the sidelines behind. The hardest part of professional trading isn't learning to wait, it's learning when to stop waiting. This critical transition from strategic inaction to precise action separates systematic traders from paralyzed observers. Jesse Livermore developed specific signals that transformed patience into profitable execution. Missing these signals meant missing the moves that justified all the discipline, all the mathematical preparation, all the sitting. The art of waiting required knowing exactly when to stand up and act decisively. Livermore's character change protocol was mathematical, not emotional. He didn't rely on gut feelings or hope-based assessments. The first signal demanded immediate attention. The first lower low plus lower high on expanding volume after an extended run. When this pattern prints and the tape shows heavy offers, wider spreads, faster downticks, aggressive selling into strength, take partial profits immediately and tighten stops to break even or better. This isn't guessing at tops. This is acknowledging confirmed distribution. Picture a stock running from 40 to 40 to 58 over 20 sessions. On day 21, it breaks yesterday's low at 57.2, rallies weekly toe 57.2, rallies weekly toe 57, 90, then closes at 56, 80 on 1, 7 times average volume. That's not noise. That's institutional distributing beginning. The lower high at 56, 80 on 1, 7 times average volume. That's not noise. That's institutional distribution beginning. The lower high at 57, 90 shows buyers losing conviction. The lower low shows sellers gaining control. The expanding volume confirms this isn't random, it's character. Change requiring immediate response. Trim 1/3 of your position and raise stops under the last constructive swing point. The second signal demands even faster action. Violation of your pivotal point. If price closes back through your entry pivot on expansion and cannot reclaim within 1 to 2 sessions, it's no longer your trade. The setup that attracted you has failed. The structural level that provided your edge has been compromised. Exit immediately regardless of profit or loss. Think of a breakout at 5. One that treads and holds 5. One that treads and holds 50, 40, giving you a structural stop at 50.19. 12 weeks later, price closes at 50.19. 12 weeks later, price closes at 50, 5 on 2.2 times volume, and fails to reclaim $50.40 over the next 2 days. That's a completed message. Close the position without debate. Even winning trades have expiration dates. Time-based exits prevent capital from stagnating in directionless movements. If after your last pyramiding edition the stock drifts sideways for 10 or more sessions with contracting range and volume, lighten positions or exit entirely. Waiting is a position, but dead money is risk. Capital tied up in stagnant ideas cannot capitalize on emerging opportunities showing clear momentum and volume expansion. Calculate opportunity cost ruthlessly. If your position isn't progressing within reasonable timeframes, other setups are developing that deserve your attention and capital. Professional traders rotate capital from slow ideas to fast ideas, from unclear setups to obvious ones. They don't marry positions, they manage them mathematically through systematic protocols. Professional traders skip choppy conditions entirely through systematic recognition. When average true range collapses below recent norms, volume drops 30 to 50% below average, and price stays trapped inside prior day's range, your edge is complete inaction. These conditions destroy more accounts than any technical pattern failure because they encourage overtrading in low-probability environments. Livermore captured this wisdom perfectly. There is a time to buy, a time to sell, and a time to go fishing. Fish during the chop, when markets lack clear directional bias, when volume suggests institutional disinterest, when volatility contracts to meaningless levels, step aside entirely. Preserve capital and mental energy for periods when conditions favor decisive action. Use this daily decision framework to maintain systematic discipline. Write down your answers to these 5 questions every session. Is price still above the last pivotal point? Did we print a lower low and lower high on expanding volume? Has the tape sped up against my position with wider spreads and faster downticks? Is my stop still positioned at a structural level, rather than an arbitrary percentage? Am I considering additions from boredom or genuine opportunity after confirmation? This checklist removes emotion from critical decisions by forcing objective evaluation of current conditions. Written assessments survive stress better than mental ones. When your journal shows 3 consecutive days of deteriorating tape action, you have mathematical evidence supporting exit decisions rather than relying on feelings that change with every tick. Emotional traders rationalize away clear signals because acknowledging them requires uncomfortable action. The amateur waits for pain to decide riding winners back to break even or beyond, holding losers until forced capitulation, making decisions based on account equity rather than market structure. They exit when hope dies rather than when evidence accumulates. This backwards approach guarantees they'll sell strength and buy weakness, the exact opposite of profitable behavior. The professional waits for confirmation to decide exiting when structure breaks, not when pain peaks. They make decisions based on price and volume evidence rather than profit and loss fluctuations. They understand that protecting capital during uncertainty is more important than protecting profits during obvious distribution. This distinction separates survivors from casualties. Why do 90% fail when Livermore would have stayed put? They trade identity before process. They need to feel like active traders rather than patient capital allocators. They crave action over confirmation, motion over mathematics, activity over achievement. Their ego demands constant market participation regardless of opportunity quality. Livermore stayed put after pivotal points confirmed his directional bias. He funded patience through proper position sizing that eliminated fear-based decisions. He protected positions with structural stops placed at meaningful levels rather than arbitrary percentages. He exited when character changed rather than when emotions peaked. This complete system integrated entry, sizing, holding, and exit protocols into cohesive methodology addressing every phase of the trading process. The complete Livermore system works because it transforms trading from emotional gambling into mathematical business. Cut losses fast when structure breaks, not when pain peaks. Size positions small 0.5 to 1% risk until the market proves you right through price and volume confirmation. Wait for pivotal points with volume expansion before entering any position. Add only to strength using the 1-1-2 pyramiding ladder that risks only open profits. Most importantly, have the courage to make waiting your strongest position when conditions don't favor action. Own your process, not the market's whims. Master these principles, and you'll join the 10% who survive and thrive. The mathematics work, the psychology works, the discipline works, but only if you work the system completely rather than selecting convenient pieces while ignoring uncomfortable requirements. If this framework resonates with your trading journey, our next lesson on Livermore's pyramiding playbook will show you the precise mechanics of scaling into winners while protecting your core capital. The mathematics of building wealth through confirmed strength awaits your disciplined application.